Welcome to the deep dive.
Yeah, and today we are jumping straight into something pretty big.
Cisco's Q1 fiscal year 2026 earnings call. This one was a big one. It dropped right after the market closed on November 12th.
A huge one. And, the material you sent over, it confirms this wasn't just some routine check-in, right?
No, not at all.
It was a definitive victory lap, a complete validation of their whole strategic pivot toward AI.
And the market saw it that way too. The stock moved up, significantly?
Oh, yeah, and on 3 times the average trading volume. I mean, that's the street saying, okay, we believe you now. This isn't aspirational anymore. It's transactional.
So let's establish the foundation first, the clean beat, because we really need to look beyond the headline numbers to see what's going on.
Absolutely. So on the top line, revenue hit $14.9 billion.
Comfortably beating the consensus of, $14.77 billion?
Exactly. So that's a solid 8% year-over-year growth. Strong, but not necessarily earth-shattering on its own.
But if we look at the profitability, that's where the efficiency really shines through.
That's the story. Non-GAAP EPS. So, stripping out some of the accounting noise to get a clearer picture, came in at a clean $1.
Beating the Nodders in 98 consensus.
And crucially, that's 10% year-over-year growth. So they're growing earnings 2 full percentage points faster than revenue. That is a powerful sign of operating leverage.
And the composition of that revenue tells a story too. Product revenue was clearly the engine.
Oh, for sure. Up 10% year-over-year. Service revenue grew a more modest 2%. This just confirms that the massive hardware refresh, the infrastructure build-out, that's what's driving everything right now.
And we can't forget capital allocation.
Right. They deployed $3.6 billion through buybacks and dividends. That's 125% of their free cash flow in the quarter.
That's management signaling extreme confidence.
It's them saying, we believe this demand is durable and we're going to reward you for it.
Okay, let's move to the main attraction, because this deep dive is all about the AI infrastructure engine. It's one thing to talk about AI exposure. It's another to back it up with hard material numbers.
Which they absolutely did. The transactional proof is, it's undeniable. Management booked $1.3 billion in AI infrastructure orders from hyperscalers.
In Q1 alone.
Just in Q1. That's a gigantic number. And it instantly moves the AI story from just a general industry trend into a specific procured revenue stream for Cisco.
And they gave us the roadmap for the full year.
Yep. They're now projecting to recognize approximately $3 billion in AI infrastructure revenue from hyperscalers for the entire fiscal year 2026.
So this isn't theoretical future money. This is concrete, scheduled recognition.
Exactly. And what's fascinating here is how they're doing it. It's not just one product, it's their entire technology stack.
So let's start with the silicon, because that's the brain of the network, Silicon One. When they talk about performance and power efficiency, what does that actually mean for the customer?
It translates directly to speed and scale. The key component is their 51.2 terabits per second Ethernet router. You have to think of it as the ultimate traffic cop for just massive amounts of data.
For that inner data center traffic.
Right. In AI, you're moving these colossal data sets between GPU clusters. If that flow has any latency, your $100 million GPU cluster just sits there, idle.
So this speed isn't a marketing number, it's an economic enabler for their clients. And they mention shipping their 1 millionth Silicon One chip in Q2.
Yeah, which is just tremendous volume validation for the platform.
And what's the second piece of the puzzle here?
It's the optics from Acacia. They're seeing really robust demand for their coherent, pluggable optics. This is the tech that lets you transmit data over longer distances at higher speeds.
And what gives them the edge there? Why is that so critical?
Market reach. The optics are being adopted by all the major hyperscalers, and crucially, these things are often used in competitor systems or even in generic white box systems.
So they don't need to win the whole contract.
Exactly. They can still win the high-margin component business inside the AI cloud. It's a huge flexible footprint.
That's a really critical point. But the story isn't just about the biggest cloud providers, right? They talked about the demand broadening out.
Correct. We learned that the pipeline for high-performance networking across sovereign clouds, neo-clouds, enterprise customers, it exceeds $2 billion for the rest of fiscal 26.
And here's where you find the potential upside that the market might not be pricing in yet.
What's that?
Management specifically said that this massive sovereign and neo-cloud revenue is largely back half weighted, and it's not materially included in the current year's guidance.
Wow. Okay, so that sounds like a powerful source of a potential beat later in the year.
It absolutely poses an upside risk to their forecast, and you can see their confidence in the partnerships they mentioned.
Like the expanded G42 partnership with AMD GPUs
Yeah.
and the new NVIDIA one for the N9100 switch, they're getting integrated across the whole ecosystem.
Okay, let's shift gears and tackle the big question that always gets ignored when the headlines are all AI. How healthy is the core business?
This is the most important question for a long-term investor. If you strip away all the high-flying AI numbers,
Take them out of the equation for a second.
the rest of the business, so classic enterprise, commercial, small business, it grew 9% from an orders perspective in Q1.
9%.
9%. That is a foundational data point that just screams acceleration.
And it ties directly into that multi-year campus refresh cycle they've been waiting for.
It's finally here. Enterprise networking orders were up 4% year over year, and management confirmed there is a massive multi-year, multi-billion-dollar refresh opportunity happening right now.
And this is being driven by those legacy Catalyst 4K and 6K platforms hitting end of support.
Right. These are mission-critical pieces of hardware that simply have to be replaced.
But why are they replacing them now? It seems faster than usual.
Because it's not just about replacing old hardware anymore. It's about getting ready for AI inferencing. The new solutions, like the Cat 9K series, Wi-Fi 7, they're ramping faster because customers know their old networks just can't handle real-time AI workloads at the edge.
So the enterprise refresh is being pulled forward by AI. That makes perfect sense.
Yeah, and the integration of security directly into these new platforms is a huge differentiator that's driving that speed.
Okay, so we have to address the one number that, on the surface, looks like a potential crack in the armor. Security revenue was down 2% year over year. What's the real story with Splunk?
Yeah, this is where we have to dive into the accounting, because what looks like a headwind is actually a really positive sign for the long term.
So break that down for us.
Okay, so think of it this way. Traditionally, you sell an on-premise software license. The company recognizes most of that revenue up front. Big lump sum.
Right when the customer gets the box and the license.
Exactly. But now, more and more customers are shifting to cloud subscriptions. And with a subscription, you recognize that revenue ratably, so evenly, over the life of the contract.
So the total cash value sold was actually higher, but the amount they were allowed to recognize on the income statement in Q1 was smaller.
Got it. So how do we know Splunk is healthy? We look at two other metrics: Splunk's annual recurring revenue, or ARR, and their product RPO remaining performance obligations.
RPO is basically revenue that's already sold and guaranteed, but just hasn't been recognized yet.
And both of those grew by double digits. So underlying demand is very strong. It's just a timing thing with the accounting.
That is a crucial nuance. Okay, so beyond Splunk, they also talked about pushing AI innovation right to the edge.
Yeah, they highlighted the Secure AI Factory and, even more interesting, the Cisco Unified Edge. They called it an industry-first converged platform for real-time inferencing.
Think like a smart factory floor, a hospital, a busy retail store.
Exactly. Places where you need to analyze data instantly. Low latency is critical, and this brings the AI processing closer to where the data is actually coming from. It's a huge competitive moat.
Let's quickly wrap the financial health check. Non-GAAP gross margin was 68.1%, down a bit.
Which is pretty natural when you're ramping new product lines that quickly. It's just a mix and pricing thing.
And operating cash flow was down 12% year over year. Should that worry us?
Not based on their explanation, no. It was down to $3.2 billion, but they said that was directly due to working capital investments, basically spending money to secure supply.
To meet all that AI demand.
Right. They're buying up Titan components like DRAM, PCB, and optics.
Which leads us perfectly into the confidence they showed in their guidance. I mean, this is what really sealed the deal for the market.
The material raise was unmistakable. They're now expecting revenue in the range of $60.2 billion to $61.0 billion.
That's a full billion-dollar increase at the midpoint from their prior guidance.
A full billion. And the bottom line followed right along. Non-GAAP EPS is now expected in the $4.08 to $4.14 range. This isn't a cautious raise. This is management betting on continued acceleration.
They even compared this AI build-out to the late 90s internet boom.
They did, but they highlighted two crucial differences. First, the pace of the transition is just way faster today.
And second,
this is fundamentally different from the dot-com era. The companies driving the spending, the hyperscalers, they have incredibly strong balance sheets, they generate massive cash flow, and they're profitable.
right.
They see this AI investment not as some optional R&D project, but as existential. that fundamentally changes how sustainable this spending cycle is.
And that ties right back to their supply chain comments.
It does. Despite the rising component costs, they confirmed it's all factored into the new guidance. They're actively securing supply. They increased inventory and purchase commitments by $1 billion in just the last 90 days.
They're making sure supply doesn't become the bottleneck.
Exactly.
Okay, all of that points to tremendous confidence. So let's transition to our segment. This is purely a thought experiment based on the information in the call.
This is not financial advice.
Absolutely not. But the core thesis here, based on the data, seems to be that the market has fully priced in that sensational $3 billion AI hyperscaler number.
That's it's priced in.
But it's fundamentally undervaluing two other drivers that are hiding just beneath the surface.
Okay, what are they?
First, that 9% underlying order growth for the core business in Q1. It's being totally overshadowed by the AI headlines, but it makes the company so much more resilient.
And second, let me guess, the Splunk story.
Exactly. The market is mispricing the long-term, stickier revenue that's building up in Splunk's RPO. That's future revenue that just hasn't been recognized yet.
So we need an outrageous but plausible idea to capitalize on this.
Let's structure a medium-term spread. The idea is to go long Cisco shares.
Okay, so you're betting on multiple expansion as the market finally wakes up to the core business acceleration and that Splunk revenue starts converting.
And to hedge that bet and capitalize on that competitive advantage they have in the campus refresh.
You short a basket of legacy enterprise networking companies.
The ones that lack a unified security and networking platform to capture this AI-driven modernization cycle.
I like it. And the catalyst you'd be watching for would be continued double-digit growth in Splunk's ARR.
And faster than expected conversion of that $2 billion sovereign and neocloud pipeline in the back half of fiscal 26. It's a great setup that plays right into the confidence management showed.
So to summarize today's deep dive, you have two core durable drivers coming out of Q1. First, definitive AI infrastructure traction, cemented by that $3 billion FY26 revenue target.
And second, the accelerating multi-year campus and enterprise refresh, validated by that 9% normalized order growth in the core business.
Oh, the powerful combination.
Which all boils down to one final provocative thought for you to consider. The question isn't just if AI will happen, it clearly is. But how quickly companies like Cisco can monetize the shift from centralized data centers to the unified edge they just announced.
Right. Their whole platform advantage relies on integrating networking and security for AI inferencing right at the edge. How long can their competitors just rely on partnerships to stitch those capabilities together?
Before customers demand a truly unified platform approach.
The architecture of the AI era is being built right now, and this call suggested the connectivity layer has a clear frontrunner.
As always, thank you for sharing your source material with us. You know the drill. None of this information constitutes financial advice, investment recommendations, or an endorsement of any trade ideas. Do your own diligence. We'll be back next time for another deep dive.